Quote of the day. The big money is not in the buying or the selling, but in the waiting. Charlie Munger.
Hello and welcome to my channel. Today, we will be diving headfirst into the world of investing. I know what you're thinking, investing can seem like a daunting task, but trust me, it doesn't have to be. Over the years, we've had the privilege of helping countless individuals just like you take their first steps towards financial freedom. In this video series, we're going to unlock the secrets of smart investing, and by the end of it, you'll understand how to double your money potentially. But here's the kicker, we're going to do it the smart way, just like one of my all-time heroes, Charlie Munger, the legendary investor and Warren Buffett's right-hand man. So, why is this important? Well, because I believe that everyone deserves a shot at financial success. Whether your goal is to retire comfortably, travel the world, or simply enjoy more freedom, smart investing can get you there. And trust me, it's not reserved for the financial elite. It's for everyday people like you and me. But before you get overwhelmed, let me tell you something Charlie Munger taught us. Investing doesn't have to be complicated. In fact, it's often the most straightforward strategy that yields the best results. By the end of this video series, you'll have a clear roadmap to start your investment journey. You'll understand the different types of investments, smart strategies, and even the common mistakes to avoid. So, whether you're just starting out or looking to fine-tune your approach, this video is tailor-made for you. So before we jump in, do me a favor. Hit that subscribe button and ring the notification bell so you never miss out on our valuable financial insights. And if you find this video helpful, don't forget to give it a thumbs up and share it with anyone you know who's ready to make their money work for them. Alright, let's channel our inner Charlie Munger and begin this exciting journey towards financial empowerment. So, grab your notepads, because class is in session. The first key point to discuss in this video today is an important one to start with. So, let us kick things off by answering a fundamental question: what is investing? At its core, investing is like planting a financial seed. It's the process of putting your hard-earned money to work with the goal of seeing it grow over time. Think of it as making your money hustle for you, rather than just letting it sit idle in your bank account. Imagine you have a little money tree. Every time you invest, you're watering that tree. Over time, it starts to sprout, and eventually, it bears fruit, which represents your profits. The beauty here is that the more you water, invest, and the longer you wait, the more fruit you get. Here's the best part: investing isn't reserved for the wealthy elite. Anyone, yes, anyone, can start. Whether you have $100 or $10,000, investment options are tailored to your budget. So, if you're ready to plant your first financial seed and watch it grow, keep watching. We've got more insights coming your way. But first, let's explore the magic of compounding in our next segment. In this part, we will unravel one of the most potent forces in the investing universe, the magic of compounding. So, what exactly is compounding? Well, it's like a snowball effect for your money. When you invest, not only do you earn returns on your initial investment, but those returns also earn returns of their own. It's a snowball that gets bigger as it rolls down the hill. Picture this: you invest $1,000, and let's say you earn a 10% return in the first year. You now have $1,100. But in the second year, that 10% isn't calculated based on your initial $1,000, it's calculated on your new total of $1,100. So, you earn $110 in the second year, not just $100. The cycle continues, and your money starts to grow exponentially. To put this into perspective, let's follow the journey of two friends, Nora and Mark. Nora starts investing $1,000 per year at the age of 25 and continues to do so for 10 years. Her investments grow at an average annual rate of 7%. Mark, on the other hand, decides to start later and begins investing $2,000 per year at the age of 35 for 10 years, also at the same 7% annual return rate. Now, you might think Mark, with his larger contributions, would end up with more money, right? Let's see. Here's what their investments look like at age 65. Nora, who started early, has around $199,000. Mark, despite contributing more, has roughly $148,000. That's the magic of compounding. By starting early, Nora allowed her money more time to grow and benefit from compounding. Even though she contributed less overall, she ends up with more wealth. Imagine what compounding can do for you when you start your investing journey early and stay consistent. It's like watching your money create more money, all while you sit back and reap the rewards. So, if you're ready to harness the power of compounding and set yourself up for financial success, keep watching. In our next videos, we'll explore how investing can help you achieve your long-term financial goals. But first, let's take a closer look at the incredible journey of wealth creation over time. You see, investing isn't just about making money, it's about building long-term wealth. The longer your money is invested, the more time it has to grow, multiply, and create a financial legacy for you and your loved ones. Think of it as planting a sturdy oak tree. In the beginning, it's just a sapling, but over the years, it becomes a towering oak that provides shade and shelter. Similarly, your investments start small but can grow into something substantial. Let's look at a visual representation. Say you start with an initial investment of $10,000. In the first few years, the growth may seem slow, but as time goes by, your wealth begins to climb more rapidly, thanks to the magic of compounding. The critical factor here is time. The longer you stay invested, the more opportunities your money has to grow. It's like a snowball that starts small but gets bigger and faster as it rolls downhill. Let's consider a real-world scenario. Meet Kitty, who started investing $200 per month at the age of 25. She stayed consistent, making the same monthly contributions until her retirement at 65. Over those 40 years, she invested a total of $96,000. Now, let's see what happens. At a reasonable average annual return rate of 7%, Kitty's investments have grown to approximately $394,000 by the time she retires. This illustrates the power of staying invested over time. Kitty's initial contributions may have seemed modest, but thanks to compounding and consistent investing, she's on her way to a more financially secure retirement. Why saving isn't enough? Many people believe that saving money in a traditional savings account is the key to financial security. While saving is indeed a good habit, it might not be enough to help you achieve your long-term financial goals. Think of saving as stashing money under your mattress. It's safe, and it's there when you need it. But over time, it doesn't grow. Your money just sits there, and it's susceptible to the eroding effects of inflation. Now, let's talk about inflation. It's like a silent thief in the night, gradually reducing the purchasing power of your money. In simple terms, the money you save today won't buy as much in the future due to rising prices. Let's visualize this. Suppose you have $10,000 saved in a mattress. If the inflation rate is just 2% per year, after 10 years, that $10,000 will have the purchasing power of roughly $8,200. In simple terms, your money has lost value over time. This is where investing comes to the rescue. When you invest, you have the potential to outpace inflation. Your money grows and has a better chance of maintaining or even increasing its real value. Let's take a real-world example. Meet Daniel, who diligently saved $200 per month in a savings account. After 30 years, Daniel has saved $72,000. However, with the impact of inflation, that $72,000 has lost significant purchasing power. On the other hand, let's look at someone like Marianne, who invested the same amount over 30 years and earned an average annual return of 7%. Her investments grew to approximately $190,000 during the same period. This illustrates why saving alone may not be enough to secure your financial future. Investing allows your money to work for you, helping you stay ahead of inflation and achieve your long-term goals. Beating inflation. Saving money is essential, but what's even more crucial is ensuring that the money you save retains its value over time. Here's where we confront the sneaky financial villain, inflation. Imagine inflation as a silent thief. It slowly erodes the purchasing power of your money, making things more expensive over time. Your $100 today won't buy the same amount of goods and services in the future. To put it into perspective, if inflation is running at 2% per year, it means that you need to earn at least 2% on your savings just to maintain your purchasing power. Otherwise, you're losing ground. Take a look at this. If you stash your money under the mattress and the inflation rate is 2%, after 10 years, your $10,000 will have the real purchasing power of only $8,200. This is where investing becomes your superhero. When you invest wisely, you have the potential to not only beat inflation but also grow your wealth over time. Your money starts working for you, fighting against the eroding effects of rising prices. Let's consider a real-world scenario. Imagine you invest $10,000 in a well-diversified portfolio. Over time, it generates an average annual return of 7%. Even after adjusting for a 2% inflation rate, your investments outpace inflation, helping your money grow and maintain its real value. That's how you preserve and even increase your purchasing power over time by investing wisely. So, remember, while saving is essential, investing is your best weapon against the silent thief of inflation. It's your way to ensure that your money not only stays ahead of inflation but also grows to meet your financial goals. Investment vehicles. When you're ready to start investing, you'll encounter various options to put your money to work. These are known as investment vehicles, and they're the engines that power your journey to financial success. Investment vehicles are like different types of vehicles on a road trip. Each has its unique characteristics and advantages, and choosing the right one depends on your destination and preferences. One of the most well-known investment vehicles is stocks. When you buy a stock, you're essentially buying a tiny piece of a company. Stocks can offer the potential for high returns but also come with higher risk. Bonds, on the other hand, are like lending money to governments or corporations. They're generally considered lower risk than stocks and can provide a steady stream of income. Real estate investments involve purchasing properties or real estate-related assets. They can offer a mix of rental income and potential for property appreciation. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer instant diversification and professional management. ETFs are similar to mutual funds but trade like stocks on stock exchanges. They provide flexibility and often have lower fees. Diversifying your investments by using a mix of these vehicles can help spread risk and increase the likelihood of achieving your financial goals. The key is to select the right investment vehicles that align with your financial goals, risk tolerance, and time horizon. There's no one-size-fits-all approach, so it's essential to understand your options. In a nutshell, investment vehicles are the tools you use to navigate your financial journey. By carefully choosing the right ones and diversifying your portfolio, you can work towards building lasting wealth. We will providing more tips here in our coming videos. Stay tuned. Setting financial goals. Think of financial goals as your roadmap to success. They provide direction and purpose for your investments. Without goals, you're like a ship adrift in the sea, not knowing where you're headed. Financial goals can vary widely. They might include saving for retirement, buying a home, funding your child's education, or even taking that dream vacation. Each goal has its timeline and funding requirements. When setting financial goals, it's crucial to make them specific and measurable. For example, rather than saying, "I want to retire comfortably," you might say, "I want to retire at age 65 with $1 million in savings." The time horizon is another critical aspect. Some goals, like retirement, have a longer time frame, while others, like buying a car, might be short-term. Your risk tolerance also plays a role in shaping your goals. If you're comfortable with more risk, you might aim for higher returns to achieve your objectives faster. If you prefer stability, your goals may align with lower-risk investments. Keep in mind that life is dynamic, and your goals may change. It's essential to review and adjust your goals periodically to ensure they remain relevant to your evolving circumstances. Once you've established your financial goals, you can create an investment plan that aligns with them. This plan will determine the types of investments you choose and how you allocate your resources. In summary, setting clear financial goals is the compass that guides your investment journey. By defining your objectives, time frames, and risk tolerance, you can make informed investment decisions that bring you closer to your dreams. In our next videos, we'll discuss practical steps to get started on your investment journey. But before that, let's continue our exploration into the world of investing and why it's such a game changer. Practical tips and inspiration. Before we conclude our journey into the world of investing, let's leave you with some practical tips to kickstart your investment journey. Start early. Time is your best friend in investing. The earlier you begin, the more time your money has to grow. Diversify. Spread your investments across different asset classes to manage risk effectively. Invest regularly. Consistency is key. Set up a routine to invest a portion of your income regularly. Educate yourself. Keep learning about investment options and financial markets. Knowledge is your most potent tool. Stay informed, keep an eye on your investments, but avoid impulsive decisions based on short-term market fluctuations. Review and adjust. Periodically review your investment portfolio and make adjustments to align with your goals. Now, let's draw inspiration from a real-life story. Meet Peter. During the lockdown period, Peter decided to use his time wisely. He delved into the world of investing, studying various investment vehicles and strategies. Peter's dedication paid off. He mustered the courage to start investing in commodities, a path less traveled by many. He carefully analyzed his choices and created a diversified portfolio. Fast forward, and the results were astonishing. Peter's portfolio not only weathered the uncertainties of the market but also grew by a remarkable 30%, outperforming the S&P 500. Peter's story reminds us that with knowledge, dedication, and a well-thought-out plan, anyone can harness the power of investing to achieve their financial goals, even during challenging times. As we wrap up our journey, remember that investing is not a sprint, it's a marathon. Stay patient, stay informed, and stay committed to your financial future. If you're inspired to embark on your investment journey or to refine your existing strategy, take that first step today. And don't forget to subscribe for more valuable insights and tips on investing. Thank you for joining us on this exploration of the power of investing. We wish you success on your financial journey, and may your investments flourish just like Peter's.